Are you an investor that is having a hard time earning serious money on the stock market? Are you stuck, overwhelmed by the never-ending waterfall of financial news and get-rich-quick schemes? Not sure what works and what doesn't? Well, fear not. You're in the right place, because this is the official Value Investing Bootcamp podcast. And now, to help you skyrocket your returns, here is your host, value investing expert, Nick Krockman.
Hello, welcome back to the Value Investing Bootcamp podcast. I'm your host, Nick Krockman. And thanks again for tuning in, listening, learning, and expanding your knowledge of investing. It's a great thing that you're doing because Benjamin Franklin once said, an investment in knowledge pays the best interest. So good on you. Today I want to talk with you guys about some psychological aspects of investing, which have a dramatic impact on your results and your decisions. So it's an interesting topic, and I like psychology personally. I've read a lot of books about it, and it's just interesting to see how finance and economists, etc., just sort of forgot about this. They sort of dismissed it. They sort of said people are rational. People always do things in their own best interest and always try to maximize their utility. That's what they called it. Well, this notion is turned upside down because of a new emerging field which is called behavioral finance. This is a very interesting field of research in which they try to figure out how our minds affect our decision making, especially financial decision making processes. And some of the results are pretty startling, actually. I mean, what they found, there are two major researchers who sort of kickstarted this field, Kahneman and Tversky. With the both of them, they figured out a lot of interesting stuff. For example, they found out that, while we think we are rational, we are conscious, we have a conscious thought process. So everyone thinks, we have free will, we can think for ourselves, we can decide what we do what we want. However, their research actually suggests that by far the most actions we take are determined subconsciously, not consciously. So you don't really have any control over that. This means that you don't have control over the majority of your actions. For example, your mind takes all kinds of shortcuts because we have to make so many tiny decisions every day. It would just be impossible if we had to process it with our conscious brain, because that's actually a really slow part of our brain. Our unconsciousness is really, really fast. I think Kahneman wrote a book about, so the psychologist who founded the behavioral finance field, he wrote a book called Thinking Fast and Slow, and it's about the difference between conscious thoughts and unconscious thoughts. And the conclusion is that unconscious thoughts are just so much faster than conscious thoughts. So the result is that our brain relies heavily on unconscious decisions, and we don't really have any control over them. At least not as much as we think. But knowing that this is how it happens and that these shortcuts exist actually already helps us to sort of take some countermeasures and reduce the negative effects that they can have on our investment decisions. Just for fun, if you go to Wikipedia and look up cognitive biases, which is what these sort of shortcuts in our brain are called, you get a huge list of all kinds of factors that influence our decision making. And what this means is that all these little factors play together and play a huge role in our decision-making process. So we aren't as rational as we might think, because many of these cognitive biases sort of cloud our judgment, which can really work against you. For example, one of these cognitive biases is the fact that people attribute more value to negative news than positive news. So they don't value negative news and positive news equally. This is the result, at least that's what they expect of our living conditions in the prehistoric ages. Because that's when one piece of negative information, if you would miss that, for example, there's a lion standing behind you, it would mean certain death. While we sort of mitigated most of these risks in today's world, this bias towards negative news still exists. Also, there's this confirmation bias, it's called. It's a very interesting concept that once you made up your mind about something, for example, you decide this stock is interesting, I want to own it, your mind will sort of focus on information which confirms, that's why it's called confirmation bias, information which confirms this belief that you have. So you believe this is a good stock, and your mind will focus on information which supports that belief, and sort of shifts away all the information that shows you otherwise. So this means that you'll lose track of the downside risks because of this bias, this unconscious steering of your mind towards news that supports your actual thesis. So that's a very interesting thing that we have free will, sort of, but it is also determined by other factors which we do not have that much control over. And besides these cognitive biases, emotions also play a major role in our decision-making process. So we get, or at least we tend to get greedy when prices are increasing, and we tend to get a bit depressed when we see the stock price of our investments decline. But this is a completely irrational reaction, in fact, because you should actually be buying when prices are declining and not selling when prices are declining. I mean, if you go grocery shopping and would you rather buy when prices are increasing? So if you have to pay more for the same groceries, or would you rather buy them at lower prices? I mean, it's the same with stocks. Everybody knows buy low, sell high, but hardly anyone does this. And a big part of this is just emotions get in the way. They base their decisions based on fear and greed rather than on rational thinking. So if you want to, if I can give you one tip here, just sort of try to minimize the effect emotions have on your decision making. Try to remove them from the equation, so to say. One way to do this is to sort of stay away from the financial news as much as possible, because it just creates this massive hype or massive pessimism or whatever. You get caught up in it, and you'll get emotional. Also, if you watch your stocks too closely, if you see them fluctuate on a daily basis, this also might trigger emotions. Warren Buffett once said that he only buys stocks when he is perfectly fine if they would close the stock market for the next 10 years, you know? And another way to, sort of remove emotions is by creating checklists and spreadsheets just to automate things, so you cannot really tinker with them, so it really keeps you consistent. That really helps to remove emotions and to make better investment decisions. In the next lesson, we'll talk about how you can sort of fire your broker and do things yourself. So manage your own portfolio, pick your own stocks, and still make very, very handsome returns. If you like the show so far, please rate it on iTunes. Tell me what you think. Because this would really, really help spread the word and allow other people to find out about this podcast and learn about value investing. So thanks again for listening, and I'll see you in the next episode.
If you enjoyed today's show, head over to valueinvestingbootcamp.com to find out more on how you can invest like the pros, manage your own portfolio with confidence, and consistently earn mind-boggling returns on the stock market.